Okay, welcome to the August 16th edition of the Fats, Fuels, and Oils webinar. As usual, we've got a lot of stuff to cover today. We're going to start with talking a little bit about choice weight grease, and then talk about the USDA reports, and then go through our usual review of our biofuel margin assessment and our outlook for credit prices. All right, with that, let me get started here and share my screen. All right, so choice weight grease. Choice weight grease prices have remained, they've been a lot like a lot of the other fats and greases where they're off their highs, but they have come back and they remain pretty close to their highs. The odd thing about choice weight grease is that that's different from the other feedstocks is that we're actually projecting a year-over-year decline in choice weight grease and biofuel usage for the second consecutive marketing year. And I think, and honestly, I just noticed this when I was writing this week's commentary, so I haven't had a time to look into it very deeply, but I'm definitely going to. A lot of choice weight grease goes into the feed industry, and typically what I say when I say that in a situation like this with another feedstock, let's say, that wasn't used so much in the feed industry, what I would say is that for a lot of non-biofuel industries like oleochemical or other industries, that fats and greases represent a relatively small part of the total cost structure, and so those industries can pay up. And so maybe what it is, and for choice weight grease, is that those industries are deciding to pay more than biofuel can kind of pay for choice weight grease. However, a lot of choice weight grease goes into the feed industry, and margins in the feed industry are notoriously thin. And so I think it may be more a case of there's been a shift in non-biofuel demand, and that less choice weight grease is going into the feed industry than has in previous years. Again, it's something that I kind of noticed today, which surprises me a little bit, but something that I will look into. And when we cover choice weight grease again next month, I probably will talk more about it than I can or than I'm prepared to today anyway. Outside of that, production remains really strong, in part due to an increase in slaughter numbers. We're projecting that slaughter goes up by about 1 million head this year from last year, and also rising yields. Now, again, this is different than we're seeing in tallow, where we're actually seeing falling yields in tallow versus rising yields in choice weight grease. The theory on that is again that with beef prices at historically high levels, the portions of the tallow may actually be ending up on the beef counter or something like that. Whereas it's not essentially seeing a big hunk of fat in your pork chop isn't as attractive as it can be for some of the beef cuts. Anyway, production is up, and imports are also relatively strong and are going to nearly double from last year based on our projections for the 21-22 marketing year. And that follows along again sort of with tallow, where we've seen a big surge in tallow imports. And so despite the fact that we're seeing non-biofuel or biofuel demand kind of weaker year over year, it is being offset by a sort of a similar increase in non-biofuel demand. And so what I think that really highlights, and I think that you're going to see this in some other commodities like canola oil, where there's strong demand from the biofuel industry for, say, UCO, and UCO is not a great example, or soybean oil. And that leaves a gap in other industries that were using soybean oil or whatever on the fats and grease side that is being filled by canola oil on the partially canola oil on the vegetable oil side, and apparently choice white grease on the fats and grease side. So even though choice white grease demand is not purely a function of growth in renewable diesel production capacity, there still is an impact from that growth on choice white grease demand, because we still have all of the demand that we had before the growth in renewable diesel. And now that we're shifting a portion of the supply of vegetable oils and fats and greases into the renewable diesel industry, there are going to need to be things that fill in for that supply or substitute for that supply that is getting taken up by the renewable diesel industry. I hadn't really thought, the reason that I hadn't, I guess, noticed the year-over-year decrease in choice white grease in part was because I was just kind of under the general assumption, and assumption's not the right word there, because I guess I was operating under the theory that since fats and greases are all sort of preferred feedstocks, that demand would go up for all of them. And so obviously I wasn't paying close enough attention to the choice white grease data. But I do think that it's interesting, and like I said, something that we will take a little bit deeper look at and try and talk a little bit more intelligently about the next time we cover choice white grease. In terms of price forecasts, you can see our price forecasts look a lot like the other fats and grease price forecasts, where we expect sort of some strength heading into the end of the year, and then a little seasonal weakness in January and February when biofuel demand declines, and then some continuing strength. But in general, prices continuing in sort of the same range that we've seen them in over the last 6 months or whatever it's been. Okay, with that, let's shift to vegetable oils. And I know that this is supposed to be fats and grease week, but since we got the USDA report last week and there were some other changes, I did want to talk about vegetable oils too. So the biggest surprise in USDA's report on Friday was an increase in their forecast for the soybean yield for the U.S., the average U.S. soybean yield. They raised it 0.5 bushel per acre from 51.5 to 51.9, I guess, maybe a little bit less than 0.5 bushel. And that is a little surprising given the fact that the time that USDA is sort of looking at conditions for yields is generally around the first of the month. And so I think I talked about it a couple of weeks ago, a good way to kind of estimate month-to-month changes in USDA's yield forecast is to look at the change in crop conditions from the first week in the prior month to the first week in the month of the report. And that'll give you kind of some sense, at least generally directionally, what USDA is going to do. Now, the August report is always a little bit tricky because the USDA is using a trend line yield in July. And so like we saw in soybeans this year, there was generally a decline in conditions from the first week in July to the first week in August. But the objective models still suggested a higher yield. That's important for a couple of reasons. One, I think that it means the trend line is probably higher, and this is something that I've thought about for a little bit more than a year, and that discussions with people in the seed industry have suggested is coming. So what the people in the seed industry have kind of said is that over the next 5 years, you're going to see a significant increase in yields, in part due to greater drought tolerance, but also just in part due to the ongoing improvements in seed technology as we move forward through time. The way that they talked about it, and given they're in the industry, so they should be excited about their product, but the way that they talked about it would suggest that a 51 whatever yield per trend line could be a couple of bushels too low. And if that's the case, then what is happening right now in terms of a shift in the weather pattern is probably really important. So in addition to the sort of surprise increase in the yield forecast from USDA last Friday, over the last week or so, maybe a little bit less than a week, we've had a shift in the weather models. And initially, the shift didn't look like it made sense. Just if you remember back to the maps that I showed you a couple of weeks ago, if you've watched those maps for 20 years, you start to get a sense of changes that sort of make sense and changes that kind of don't make sense. And initially, what the models were suggesting didn't necessarily make sense, where sort of you have this very strong ridge in the middle of the country, and it just kind of disappeared. It just kind of broke up and went away. And that's not usually how those things happen. And usually what happens is the ridge kind of retrogrades back between sort of the Western Corn Belt and in the mountain region, and kind of moves back and forth there all summer. What we've seen since then is that the ridge is retrograded all the way out nearly to the Pacific coast and moved much further northward. And so if you remember that sort of those lines, and kind of what I said is between sort of the 582 line and the 588 line, that's where you can expect rainfall, particularly on the eastern side of the ridge, where the lines are sort of coming back down or moving from north to northwest to southeast. And so now it looks like the setup for the next couple of weeks is that where the ridge is moved relatively far west, and there are at least some opportunities for rainfall, particularly in some of the driest areas of the country. Now, I think you could say, well, that doesn't necessarily make sense either. What you said is that the ridge generally kind of moves from the Western Corn Belt to the mountains and then kind of back and forth again. Why would it shuffle off way up into Seattle? But we're already seeing kind of some of the effects of this. So yesterday and today, it's been raining in Iowa and Nebraska and Missouri, which have been the areas of greatest concern for much of the summer, and certainly over the last part of the summer. And if that trend kind of continues, then again, I think that sets us up for a crop that could really surprise to the upside in terms of production. And I think that the increase in the August WASDE and in USDA's yield forecast could be the first of several, and potentially there could be a couple of, or there could be at least one relatively large one. Although I think given the historical yields over the last several years, I think it'll be tough for USDA to move yields up too much, just based on the fact that, one, conditions aren't that great, and two, there's no real history to suggest that we should jump from sort of the 51 area to the 55 area. Although, again, that's kind of what the people in the seed industry had indicated, not necessarily for this year, but over the next several years, they expected a sort of a 5 bushel or so increase in the trend line, which is really huge in a relatively short period of time. However, if you look at yields, they tend to move in kind of a stepwise fashion. So you get the introduction of fertilizer and yields jump up, and then they kind of are steady for a while and vary around the new range. And then you get the introduction of GMO and yields jump up, and then they kind of vary around the same range for a while. I'm not exactly sure what the technology change is in the current. I'm not sure, I guess, what the seed industry is expecting for technology change that makes that much difference. And they didn't really say that much other than that the plants would be much more robust. But it seems like we might be in for one of these jumps, or there's some potential that we're in for one of these jumps. And in that case, it probably will take a year for USDA to kind of catch up and start doing, and everybody, myself included, everybody to kind of catch up and start incorporating whatever the new level is into their expectations. Beyond that, the other thing that we talked about several weeks ago was that I think one of the best ways to ensure a good crop is to stress the plants a little bit as they are going through the earlier stages of development, because what that tells the plant is don't necessarily focus your energy on building a huge, big, beautiful plant. You really need to focus your energy on genetic material and passing that on to the next generation, which are the seeds. And so you can have very ugly soybean plants that yield very well for just that reason, because if you stress the plants a bit and then you pour water on them, effectively what you told the plant is you need to direct all of your energy towards, and of course that's very much simplifying it, but you need to direct all of your energy towards filling those pods so that the seeds can get through whatever this potentially tough period is that was indicated by the drier weather before pod filling began. I say all that to say that soybean prices could drop down to $13, and I think we're down 30 cents or so today, and we've dropped below 14 for the second time in as many days. And if we close close to where we are trading now, it probably means that we've moved below that level and may go back down and test the summer lows, which are around 13. That would tend to take soybean oil prices back to the lower end of the recent range, and 60 cents has served as a fairly good floor for soybean oil futures this summer. We've seen soybean oil futures trade a little bit below that, but not for an extended period of time, and then they've always come back and bounced and traded higher. And if soybean prices fall down to 13, I think that there's a good chance that soybean oil prices, kind of sort of the fair value is down to around 60 cents. There is a big, huge caveat to that, and that is, again, at least in the futures market, that is that speculative positioning remains relatively weak in soybean oil and oil share. And so you could get a move down to 13 in soybeans and then have specs sort of pour into an oil share trade or into just a long soybean oil trade, and that keep soybean oil future closer to the recent sort of fair value range between 60 and 65 cents than the $13 soybean futures would imply. Now, the next thing that's going to happen is the market is going to start turning its attention to the South American crop and early season planting conditions in Brazil and the potential development of the La Nina that has hampered production in South America over the last couple of years. If you look back historically, there have been just a couple of times where we've had La Ninas that have stuck around for more than 2 years. And when that's happened, what tends to happen is the first year has a pretty significant impact on yields, and then the second year has a big impact on yields. And then by the third year, yields start to recover. Now, that's probably because there aren't really I don't really remember any examples where we had La Nina over 4 years. Usually by the third year, if there's a La Nina sticking around, it's kind of on its way out. And so it's not strengthening, it's weakening. And that's kind of what the forecasters over at NOAA are saying is going to happen right now. While it looks like La Nina is going to stick around into the fall, as you go forward into the winter and then into the spring, the chances for La Nina continue to decline. It may be that as we get into the fall and get a little closer to winter and in spring, obviously the chances for La Nina could increase and we may just kind of stay here. And in that case, I think expectations for South American production in general probably will fall from the relatively lofty levels, or I guess what I really should say is from the record levels that they're at right now. I mean, we're expecting Brazilian production to be 150 million tons, which is like almost 25 million tons above where it was last year. As long as it looks like La Nina is not going to be around for the Brazilian growing season, then I think you could have another leg down in soybean prices, and you could have soybean prices fall to 12 or potentially even below 12. And that's kind of what we're forecasting right now, in part based on the idea that we're going to have normal yields in South America. And that takes soybean oil prices below the 60-cent level firmly. Doesn't mean that we get down, to sort of 40 cents again, but it does mean that that probably shifts the fair value for soybean oil to between kind of 55 and 60 cents as opposed to around 60 cents. Okay, so that's kind of what's been going on. I'm going to very quickly go through the changes that USDA made to the veg oil balance sheets. There weren't a lot of significant changes, so this hopefully won't take that long. It doesn't look like, I apologize, it doesn't look like this updated. Maybe it did update, although I don't remember this production change, and that number is wrong. No, this didn't update, so I apologize. All right, so we'll do this from memory. So for soybean oil, really the two changes that they made, they didn't really make any changes to their 22-23 balance sheets, and I apologize that the chart isn't updated. I will make sure that it updates again. I don't know why that happens sometimes. It didn't make any changes to its new crop balance sheets other than the 21-22, the old crop balance sheet ending stocks number was raised by about 150 million pounds. And that increase came from a 50 million pound reduction in USDA's forecast of imports, and then a 200 million pound decrease in USDA's forecast for soybean oil used in biofuel production. The decrease in soybean oil used for biofuel production brought it closer to our projection, but the decrease in imports left their number about 50 million pounds below our number. The net result of that was a 150 million pound increase in USDA's ending stocks, which lifted their ending stocks above the 2 billion pound level, which is relatively important from a psychological standpoint. But right now, I don't think that it's as important as it is in other cases, just because of what I've talked about that's going on in soybeans. I think the movement in soybean prices probably is more impactful than USDA's ending stocks forecast rising above 2 billion pounds, in part because we already have stocks above 2 billion pounds. So all USDA really is saying is that over the next 2 months, stocks aren't going to decrease as much as we thought they would. And I think a lot of analysts probably had already figured out that this year's ending stocks are likely to be above 2 billion pounds. The one change that USDA didn't make was they did not change their old crop export forecast, which remained at 1.775 billion pounds. Again, that's 75 billion pounds above where we are. I'm still sticking with my 1.7, and I think that this year is going to look an awful lot like last year. Weekly data still suggests that weekly export sales data still suggests that is true. Maybe I'll have to come up a little bit, but I think USDA is going to have to come down a lot more than I'm going to have to come up. And that ultimately could potentially raise their ending stocks further, just depending on what they do with non-biofuel kind of going forward. For canola, USDA broadly didn't really make any significant changes to its US or Canadian balance sheets for 22-23. The only change that it made to its US balance sheet for 21-22 was an increase in its forecast for canola oil used in biofuel production. I think it was about 200 million pounds. I think that's right. Or maybe it was 100 million. I know they were a bit below us, and we were about 1.25, I think. And the change that they made brought their number more in line with our number. But other than that, they didn't really make any changes. The one thing that I would note on canola is that this week we made some changes to our Canadian canola seed balance sheets based on a 1.4 million ton reduction in our forecast for production. We dropped it from 20 million tons down to 18.6 million tons. And that's due in part to the fact that while we're seeing this improvement in conditions for soybeans, and it could mean that we have a bumper soybean crop in the US, conditions for canola matures a little bit earlier than soybeans. And so conditions for canola or pod filling for canola, the pod filling stage of canola did not experience as good conditions as soybeans have. Now, that said, it certainly doesn't look anything like last year, where there was a huge drought and production in the US and Canada declined sharply from sort of initial expectations. And the 1.4 million ton cut for the Canadian crop isn't really, it's not a huge cut, and it wouldn't surprise me if maybe it comes up a little bit as farmers really get into harvest and the crop starts to get in the bin, and we can kind of really figure out what it is. USDA didn't make any changes to its US canola production forecast, and we haven't really made any changes to our production forecast either. On that one, I could see maybe some cuts in the future, but I don't think we're going to get anywhere close to the levels that we saw last year. Finally, for palm oil, USDA didn't make any changes to its palm oil balance sheets, but USDA really isn't the guiding data set for palm oil. It's really the Malaysian Palm Oil Board data. And the Malaysian Palm Oil Board indicated that stocks at the end of July rose, I think, about 11%. Actually, I can look at that. This one, we do have stocks for July, rose 7.7% from June. And that was due in part to the production that was generally in line with market expectations, but exports that were stronger than expected by the market or by us. And those stronger exports were offset by a big bump in imports and then weaker domestic demand. Now, based on the MPOB report, we did end up cutting 200,000 tons out of our production forecast. So we're now at 18 million. We also raised our ending stocks forecast from 1.75 million to 1.95 million tons. I probably could have pushed the ending stocks forecast above the 2 million ton level, but everything kind of fit well together at 1.95. The big question going forward will be exports. Indonesia just raised their reference price, so for export taxes, so that makes Malaysian exports a little bit more competitive. And cargo surveyor data for the first 15 days of the month was pretty varied. It was all the way from sort of a 2% decrease to a 10% increase relative to the same period the prior month. I think of the three services, I think the one that probably carries the most weight in the market was the one that suggested that that exports were up 10% from the same period in July. And so there's some upside risk to our export forecast. And that's why I didn't really go with raising our ending stocks number above the 2 million ton level. What I will say is that I also adjusted the next 2 years forecasts, and both of those, at least right now, feature ending stocks that are above that 2 million ton level. What that suggests is that the spread between palm oil and soybean oil is likely to remain historically wide. Now, last week, the movement in palm oil really was close to the movement in soybean oil, at least in terms of sort of the line that you draw for daily closes. But the rally in palm oil wasn't as sharp as the rally that we saw in soybean oil ahead of the USDA report. So soybean oil prices rose by about 3.5 cents. Palm oil didn't really rise that much, and as a result, the palm oil spreads continued to widen. And so for the October contract, that spread is now around 24 cents, which is in the range that we think makes sense. Between 20 and 25 cents is kind of what we're forecasting going forward. However, if exports don't remain, if they don't accelerate a little bit, not a ton, but a little bit from July's level over the next 2 months, then I think that expectations for ending stocks will rise above 2 million tons for 2021. And that will make it awfully tough for palm oil prices to rally at least significantly relative to soybean oil and really start to narrow that spread. So I think that spread probably stays again between 20 and 25 cents. Last summer, obviously, we saw it blow out to like 30 cents. I don't think this is a situation where the palm oil spread just keeps rising and rising. But again, if palm oil exports don't pick up a little bit, then you could see that spread test the 30-cent level. If not in the next couple of months, maybe by the spring. And that's because the last thing that I'll say about vegetable oils is that we've gone through and kind of adjusted a lot of our 22, 23 and beyond biofuel forecasts. My soybean oil use in biofuel prediction now is much more closely aligned with USDA's number, which wasn't the goal, but that was just kind of where we ended up. And that gave me that reduction allowed me to cut imports to what now seem like a reasonable level of 500 million pounds for 22, 23, and also raise non-biofuel back above 14 billion pounds for 22, 23. All of that takes ending stocks down to about 1.5 billion pounds. Last week, we talked about sort of this Charlie Brown and Lucy situation where every year analysts have expected soybean oil stocks to fall in some cases significantly below 2 billion pounds. And every year we've ended up at 2 billion pounds or above. or right around 2 billion pounds anyway. But that 22, 23 really looks like finally the year that that we will get some tightening in stocks. And what I would say is that given the fact that we made pretty substantial reductions in our soybean oil use in biofuel production, and we still are at 1.5 billion pounds. Now, granted, non-biofuel use could come down from our forecast, which is in line with the last couple of years, but it's at the upper end of the range of the last several years. 14.25, you could easily have that at 14 or 13.75. And if you're at 13.75, we're back to 2 billion pounds again. But it does seem like, at least at this point, that everything kind of fits together to suggest that 22-23 will be the year when soybean oil inventories start to tighten and potentially tighten pretty substantially. All right, with that, let's get on with biodiesel. All right. So on Thursday, the EPA will release data from its moderated transaction system, the EMTS system, which provides us monthly data for RIN generation and production by gallons. This is the chart of the HOBO spread versus biodiesel production relative to the 5-year average. As you can see, this is not the tightest chart that you've ever seen, or it doesn't cluster around the trend line in a way that would give you a ton of confidence in your predictions. With that said, I think that the recent movement that we've seen in the HOBO spread in July, which is the month that we're going to get data for, may mean that our predictions are a little low. You had, really good biofuel margins in June, and in July, the HOBO spread remained relatively low for a big portion of the month. But we're predicting that at least for domestic biodiesel production, it's going to fall 20 million gallons from its 5-year average. Now, part of that obviously is, you can say part of that is just due to the rationalization that we expect to see in the biodiesel industry. And of course, we've talked a lot about the additional biomass-based diesel production that is going to be needed this year due to the gap between ethanol production and the ethanol mandate, and the typical undifferentiated advanced biofuel mandate, the gap between the advanced mandate D3, D4, and D5 production. But I think that those things and the HOBO spread argue that maybe production will be a little bit higher. And we haven't really seen, at least from the EIA data, we haven't really seen that rationalization in biodiesel capacity that we had expected to see. We'll see if that holds in the next couple of EIA reports. They're a little behind, and so maybe some rationalization has occurred, and production will be where we say it is. But I think there's probably a little bit more upside risk for the July data than this chart would indicate. All of that said, if you can find the June data on here, it is well below the trend line. And so again, this isn't the most precise tool that we have to forecast domestic biodiesel production. All right, with that, let's look at gross margins. Gross margins kind of moved in opposite ways again last week, with the biodiesel margin dropping by about 25 cents and the renewable diesel margin rising by about 13 cents. The the important takeaway here, I think, is that the margin shifted, both margins shifted back into the range that we kind of expect them to be for much of the rest of the year. You can see from the chart that we've got a little bit of weakness built in, but I would argue that if we get this big drop in soybean oil prices, or soybean futures and then soybean oil prices, that that both of these dips probably probably won't be realized, and margins probably will be a little bit higher than that. In addition to that, we're also forecasting sort of a steady decline in energy prices, and our energy price forecast might be a little bit more pessimistic than we will realize, especially as we head into the peak of hurricane season. And if there is a hurricane that goes up through the western or central western part of the US Gulf, I think you probably will see energy prices explode. But obviously we can't model on that. Beyond that, I think you see we've got sort of a rise built into our margins for the first part of next year, and that is due primarily to this expectation that feedstock costs may come down. Now, if we do get this move in soybean oil prices from, I guess, 68 or 67 cents right now down to 60 or below, I think we will finally either have confirmation or disprove my theory about fat and grease supplies being, excess supplies being relatively close to zero. Then you'll never have to hear me talk about that again. If soybean oil prices fall and we don't see fat and grease prices kind of fall with a 4 to 6 week lag, or maybe even a little bit longer than 6 week lag, then I think we can assume that whatever source of demand, whether it's renewable diesel for a lot of the fats and greases, or other industries, apparently for choice white grease, that the demand is strong enough to support prices at historically high levels and to further stretch what has been the historical relationship between soybean oil prices and fat and grease prices. We are going to get to that point someday as we continue to expand renewable diesel capacity. Whether that day is now or not is kind of the question. And I still, as you can tell, I still kind of continue to go back and forth on this. But I think if we do get that drop in soybean oil prices without a corresponding decrease in fat and grease prices, that maybe I can finally put that theory to bed. All right, for RIN prices, our RIN forecast didn't change that much this week. Our projections were relatively close to where the market has been trading, and so not really a lot new to say here. I just didn't make any adjustments to what the model suggested prices should be this week, and so there may have been a little bit of movement in the model based on some of the changes that we've made in our feedstock forecast, but in terms of adjustments from those prices, didn't really make any. And I think the RIN price forecast is relatively close to where we were last week. For LCFS credit prices, however, we have seen LCFS credit prices start to recover again for the third time, and whether that'll hold or not, we'll see. I think that the LCFS credit market sort of always moves in ways that tend to be the opposite of what I say. So I'm going to be quiet and talk about our expectations. Again, we thought that that LCFS credit prices around the changes in the LCFS, around the potential changes after the meeting, talking about the potential changes in the LCFS credit program, sort of seemed to stabilize, and then they started to fall off, and now they've started to rally again. And so maybe the market is starting to take that those changes a little bit more seriously, and maybe prices have fallen to a point where you are eliminating some of the supply to the California market. Although, like I said, I think last week, I think ultimately the bottom in LCFS credit prices, or at least probably the hard bottom in LCFS credit prices, is somewhere around $50. But if we do stabilize around this $90 area, then I think what you probably will see in terms of shifts in our forecast is we probably will kind of erase this little part where we're projecting lower prices, and then start to build from 90. The big test will be the fourth quarter, especially November and December, when you tend to get a lot of renewable or biomass-based diesel production, so that obligated parties can meet their individual RVOs. And if we do get that, and LCFS credit prices kind of hold up, or hold that 90 level, or above that 90 level, then I think we probably build on that level next year, as opposed to assume that we're going to go much below the $90 level. And then I'll come back and tell you that I apparently the 90 is the floor. All right, with that, I will open it up in case anybody has any questions at all. And if not, we'll get done almost early this week. Never quite seem to make the 30-minute limit. All right, it doesn't look like we have any questions this week. So thank you everybody for attending. I hope you all have a great week, and I will see you next Tuesday.